Hey everyone, welcome to episode 70 of the Julia LaRoche Show. I am pleased to bring to you a returning guest to the show. We are joined today by Axel Merk. He is the founder and CIO of Merk Investments. Axel has been in the macro space for many, many years, so I wanted to get him back on the show to really understand everything that's transpiring in the global macro economy, and it's a lot. This was an incredibly illuminating and at times a sobering discussion. We covered a lot of territory, everything from the Federal Reserve's sledgehammer approach to the economy. We covered the banking crisis and why that's not over. We also got his thoughts on commercial real estate, his thoughts on the bond market, gold, his take on the de-dollarization narrative and why that's more than just theoretical. We also discussed the looming debt ceiling fight and some thoughts on capitalism and why what we've experienced, specifically the younger generations, isn't true capitalism. I really enjoyed this conversation with Axel, and I think you will too. By the way, if you are new to the channel, welcome. It is so great to have you here. Please be sure to hit that like button and that bell so you can subscribe. All of my shows are free, and your support will help me bring more great long-form conversations, especially on the macro economy that we're all trying to piece together and understand. And if you're listening to the show, please be sure to leave a rating and a review so you can help more folks find these episodes. Again, I appreciate your support. It means more than you know. Thank you so much. And I hope you enjoy this conversation with Axel Merk. Axel Merk, CIO and founder of Merk Investments. It is so great to welcome you back on the show. Thank you so much for joining me again.
Oh, it's a great pleasure to be back on.
Well, I really enjoyed our last conversation, Axel, and I want to start to get your big picture macro view. I know you're someone who's been in macro for a long time, so I want to hear what is top of mind for you today. What is that big picture macro view for you?
Sure, and maybe I should take a step back as to why I'm into quote unquote macro. Um, we used to run a kind of a mom and pop advisory shop. And then in the early 2000s, I started to maybe pay more attention, but get really upset about some of the stuff that's happening out there. And in some ways, it's therapy to talk about macro, but in many ways, the solutions to some of the big issues we're facing are so clear and they're so simple principles one could adhere to that I've gotten into this habit, on the one hand, to talk about it, but then actually do something about it. And so we run in a shop these days, have several investment products, but also in personal life, adjust to kind of the sort of world that we live in. So that's kind of the context. And also early a part of the 2000s, we were drawn into the currency world, and there's always macro stuff talked about. These days, we focus more on the precious metals side. So that's kind of the context here to all of that. But in part because we got this currency background, we do deep dives into central banks around the world. And one of the things I've always done, I've always want to go to the sources, right? I don't like to just pick up something that somebody else said and then run with it. And so over the years, some of my views have been sometimes a bit controversial, sometimes mainstream controversial, but sometimes also in the various echo chambers a bit controversial, because I do think a lot of the folks out there don't do their homework when they complain about things. So with all that said, I think we have a bit of a mess out there. I'm not telling you something that you don't know. And some of these pieces, I mean, are quite familiar, right? The big picture is the Fed is higher for longer. And so what does that mean? The Fed raising rates means they want to break stuff. That's really the plain English way of expressing that. Breaking things, of course, they don't want to break the big stuff. They want to tighten financial conditions. They want to break the little stuff. They want to get supply and demand back in balance. So they would like to have unemployment maybe a tad higher so that you don't have as many jobs available for the job seekers. And they have the sledgehammer that they're using. And then obviously when something bigger breaks, like what happened at Silicon Valley Bank, they take out the sledgehammer because ultimately they're there to protect the system. So that's kind of one of the big currents. And the other current, I just mentioned it, are the big banks. Some people say this is the most forecast recession ever. right? And so in some ways, and then people say, oh, there's really nothing bad, right? There's no imbalance here and there. The big elephant in the room are the banks. Now, I'm not suggesting them as bad a shape as in 2008, but even though treasuries are quote unquote safe securities, there is risk, as everybody is aware now, with duration risk. And then, of course, there is the commercial real estate debacle, I call it, that's looming, and we can talk about that. But there is more attention on that now. And if you're a bank that is somewhat exposed to it, it doesn't matter what lifeline the Fed has thrown to you, and we can talk about how I think that one is counterproductive. They will be lending less. So that's a headwind to growth. And then we have a Federal Reserve higher for longer, in my view, and I think I've mentioned that too last time on the program. I don't think it's a policy or strategy, it's a tactic. And so all they guarantee pretty much with that is that the falling off the cliff, so to speak, is going to be harder. Anyway, I'll pause here. I'll mention a bunch of different things.
There are a lot of great things, and it's nice outline again for the conversation. Maybe let's start with the big banks, since we've gotten bank earnings, also in the aftermath of the Silicon Valley Bank collapse. Like, what are you thinking about as it relates to the recent banking crisis, the banking panic? I wanted to hear like what your thoughts are and where we are within that.
Well, just a few days ago I think it was on Bloomberg, they mentioned, oh, the bank earnings are great, the bank stocks are rallying. And by the way, I'm not giving specific investment advice on any company I may be mentioning, but I said, well, what the hell? The earnings may be great, but all the problems are stuff that you find in the footnotes, not in the headline numbers. The securities that are underwater, that's not something that you see in the earnings per share number. And so the earnings may be great, but that doesn't mean they aren't weak. And you talked, I think if I listened to you correctly, you just talked about the bank crisis in the past. I don't think it's in the past, it's a present one. And the reason is what the Federal Reserve did is they basically went to the banks and said, listen, guys, if you need liquidity, you give us your securities, your treasuries, and we give you liquidity against it. With the little caveat, we give you 100%, meaning not the market value, but the par value. And what that means basically is that the banks are giving something they know is not worth as much as they're getting liquidity for. What incentive does that set? And what are the implications? The banks know they have a problem. Now, some say, oh, if they just write it out, it's all good. But there are two sides to the balance sheet, right? If they have with deposit withdrawals, that hole is just getting bigger. So there is more stress that's happening there. These banks will not be lending. And if you paid attention, and I'm not saying you didn't, but if anybody has paid attention, you may have noticed that First Republic has not gotten any equity injection. And if you've ever done fractional reserve banking 101, well, you can improve your situation by putting in deposits. And we heard the big banks putting in 30 billion. But money on steroids is if you put in equity. Well, the reason why they haven't put in equity is because if you take First Republic, I don't have the current market value cap here in front of me, but it's like 2 to 3 billion. Well, if you put in 30 billion, the existing owners get tremendously diluted, which means if you're an existing owner, you don't want to raise equity. And so if the Federal Reserve gives you a lifeline, then you're not going to, which means you're going to be limping along. It's going to be like Japan in the 1990s. A central bank can keep an insolvent banking system afloat, but it will not be lending. And I'm not suggesting that Bank of First Republic Bank is quote unquote insolvent, because that's a technical term that I don't want to throw out there. By regulation, they're not. But they're releasing earnings on Monday, and not much progress has been made. And that's really part of the issue, right? We will be limping along with that. And then, of course, we create all kinds of unintended consequences on FDIC insurance and whatnot. But the fundamental issue in any banking crisis is a lack of capital. And that is created by a lack of mark-to-market accounting. You don't, and if you had mark-to-market accounting, you would have an incentive to have your act together. But instead, we have this huge range of red tape, and they all check the boxes, and they've checked the boxes according to those, they're okay, but the market says no.
Hmm. Limping along and kind of thinking about these unintended consequences, the bigger implications. How do you kind of think about it, or where where do you see that spreading? What are your thoughts there?
Well, the first caution is when you talk to somebody like me, macro guy, we have ideas, right? One of the I used to in 2008, I kind of spoke out quite a bit. At some point, I just decided I'm not going to talk out anymore because I don't feel like being the entertainer that's out there. And then part of the reason I say that is that it doesn't matter what I say; it matters what policymakers will do. And we know that the policymakers will bend the rules. Like the latest Fed facility is a very severe bending of the rules of principles of central banking, where it says, hey, you write collateral, liquidity against good collateral. Well, yeah, treasuries are kind of good, but not if they're underwater, you're not supposed to give that much, right? And similarly, FDIC insurance, we know that they can guarantee deposits that are higher. They change rules along the way, and it's kind of one of the principles that's being violated. People will make investment decisions if they know the rules of the game. If the rules of the game change along the way, even if it's with the best of intentions, it's a hindrance. It's counterproductive to efficient capital allocation. So people will invest according to where the next bailout is going to be, rather than based on the fundamentals. And the implications are, aside from the health of the banking system, we know that the rise of populism in recent years is in part due to that sort of attitude. We have a young generation that's losing confidence in capitalism because they think what we have is capitalism. Well, it is not. And so it's that sort of stuff that we're on a very, very fundamental basis. There are some serious concerns. Now, how do I think about it as an investor? Well, we don't invest in these banking stocks. It's not part of our mandate. So I'm not going to talk about that specifically, but it means that, well, the big banks, they don't have an issue because they are magnet. Now, just for context, right? Part of the suction of money out of banks is, of course, induced by the Fed. When you raise rates, it is in part to reduce the credit that's out there. So it's part of that flight is normal. Also, about half the money that's based on what we have seen that's gone out of the banks has gone into money market funds where the yields are higher. So it's not all the money is going out as a flight because they're spooked about the banks. But there also needs to be a very serious discussion of what the role is of these banks. And one of the roles they play, they are the smaller banks are the largest player in commercial real estate. And let's just talk about that here for a second. In commercial real estate, just like on your home mortgage, right? The loan is tied to the building that you own. It's not tied to all your assets. And a lot of commercial real estate was financed with loans that's coming due for refinancing. And so that means the cost of carrying that loan is gone up dramatically by a factor of 2 or 3 or even more sometimes. At the same time, the revenue has come down because you still have a vacancy in the office market. And so when you have a portfolio of commercial real estate, you're going to say, oh, that building is going to make a loss for me. So why don't I get rid of that? Because I can just hand over the key. So you're going to have the selective disclosure. And then the banks need to know what to do with it. Now, to take a step back, a lesson from the financial crisis is it is perfectly okay to own risky assets. If you're somebody who has a profile that, oh, they're hedge funds, whatever it is, private equity firms, they love risky stuff, right? But then the others, think banks, they have a different risk profile. And so what needs to happen is that you need to have what has now become a much riskier investment move over to hands that can afford to hold them. But all these regulators, what they're doing is they're trying to prevent that. And so they're making these banks even riskier. They put them even on shakier grounds. And at some point, something has to crack. And so they're asking for trouble with these support mechanisms. Whereas the right thing to do is when I don't know how many of your viewers have margin accounts. Well, if you buy something on margin, right, you get a margin call when things go bad. And because you know you have that threat of a margin call, you're going to think twice about how much leverage you're going to use. And so it's those sort of basic economic 101 things that are lacking in the banking world, and you have quite the opposite. And that cannot end well. How exactly it will end, nobody knows. We kind of know the playbook these days of our central bankers, but you never quite know how the dynamics will play out.
Yeah. Like as you put it, we're asking for trouble and there are consequences to these actions. Let me ask you this, because you were kind of alluding to it. What are some ways to address, remedy, or fix the situation within banks? What are some of the things that you're thinking about?
Well, back in 2008, I already said the best short-term policy is a good long-term policy. And that might sound a little odd, but if you have a solid plan, not a short-term bailout, a long-term plan, that will create more stability. Instead of, Jamie Dimon pointed out in his letter to shareholders that you should have him on the show, by the way. If you get Ray Dalio, you can get Jamie on
I
Dimon
should
on the
ask
call
Jamie,
as well.
but yeah, I did read
Yeah.
Jamie's letter. It's one of those must reads. Yeah.
Exactly. So, but what he said is that these smaller banks are tied up and drowning in red tape. Now, we think a small business, but we manage over $1 billion. We're regulated by the SEC and some other regulators, not the banking regulator, but I know exactly what they're feeling, right? There are so many new regulations that have come in. We're scrambling to keep up, complying with all the latest and greatest red tape, that it is very difficult to take a step back and focus on the big picture. So I can see very well how these smaller banks are drowning in red tape and then forget, oh my God, maybe we should manage interest rate risk, right? With hindsight, you say, yeah, you should have, but they're just capacity constrained and they're running to cross the T's that, okay, by Basel III mandate and by this mandate, everything is good. And then the market looks at it and says, oh my God, no, it sucks, right? You got a hole in your balance sheet. And so one thing is we should move back to a more principle-based regulation rather than just crossing the T's. And part of the reason is that the regulators will never, ever see all the issues. They always fight the last crisis, which gets me to the other point. You need to get the market involved in judging the health of banks. And by the way, a $250,000 deposit insurance, like at least you should have a little bit of a market mechanism that bigger depositors should do some homework when they lend money to a bank, which is what you do when you put in deposits. The other big thing is pre-2008, banks used to get the funding in the interbank funding market, which are unsecured loans that you get. Nowadays, you get it from the Federal Reserve. So you took an extremely important market-based measure away. I'm all but certain that Silicon Valley Bank would have had a tough time raising money in the funding market because the big banks pay attention. And that didn't happen. The only the two levels you have is deposits, and then you have the share price, right? And obviously, what then? And now with it hasn't been explicit, but it's kind of implicit that bigger banks are not allowed to fail anymore. At least your deposit is not allowed to take a haircut. And so the only thing you got left is the share price. So what happens then in practice is that there is no problem until you fall off the cliff. And so it's that sort of thing. Now, another way to get, without getting too technical, to get more discipline, market-based discipline in there. Any bank that's overexposed can shrink by about 10% a year, but it cannot shrink by 50% a year. And one way you can achieve that is everybody has heard about these bonds that were bailed in at the Credit Suisse situation. Well, you can have a broader framework of that rather than being a small sliver. And not everything went well when that went about, but you can have much of the funding of banks be in subordinate debt. And if you think about it, if you have to refinance 10% of that every year for 10 years out, if conditions were such that the market didn't trust you, you could say, okay, well, you shrink your balance sheet, right? And you can do that by 10%. And then, of course, my big pet peeve is the mark-to-market thing. I don't think it's excusable that it's the one area in the financial markets where you don't have mark-to-market accounting with consequences. I call them margin calls, a little different terminology in the banking world, but that's ultimately what it is. And again, it provides the incentive to do your homework because you don't want to be in a situation that when you get the margin call, you need to raise money, right? When you're in a crisis. And by having the rules clear ahead of the game, not changing them I mean, these are all very basic principles that would be, I think, very helpful if some of them were adopted, if not all of them. Yeah.
Yeah. I really enjoy listening to you because I feel like I always learn a lot, and you have a lot of like principles and maxims that usually come up in these conversations. I want to explore an idea with you. And I'm kind of thinking out loud here because it's like we've seen the rules of the game change, and you often talk about the importance of doing your own homework. And everyone knew. Well, I would think everyone would know. I knew the rule was 250,000. That's FDIC insured, nothing above that limit. So by seeing the intervention that we saw with Silicon Valley Bank and guaranteeing the depositors they didn't even get a haircut, does that create moral hazard? Meaning, I don't have 250,000 in a bank, but if I had more than 250,000 in a bank, could I just have this attitude of like, well, if my bank goes under, I'm probably going to get a bailout of sorts, or I'll be made whole, because it kind of sets a precedent at this point.
Yeah. So a few things. First of all, there is, of course, a motivation by policymakers that there's no panic out there, right? I mean, they want people to trust banks. Banks are, though, inherently risky institutions. They're geared up 10 to 1. That's risky, right? And it's a lot of money, right? I mean, it's come down, but almost 20 trillion in the banking system. Even for a country like the US, 20 trillion is a good chunk of change, right? So there's a reason, and Europe, right? The deposit limit is 100,000 euros in the Eurozone. It's 100,000 Swiss francs in Switzerland. There's a reason for that, because some banks are too big for some of these countries. And by the way, these high deposit limits do suck money out of some of these banking systems as well. If you can have a quote unquote safer place, obviously with currency risk and other things, and so there's a reason why there's no blanket insurance. And by the way, a law was passed in the early 90s that the FDIC cannot single-handedly increase that deposit limit unless for a short-term period for an emergency. But they specifically said, no, you cannot do that. And Janet Yellen has been very technical at creating some confusion in the market in that. But absolutely, investors should do their homework. And Wall Street Journal had a long article how small businesses now do more homework. Yes, that is a necessity that they do that. Of course, there's been this spreading that you can put your money, if you put your money in many brokerage accounts, you can have them in FDIC insurance deposits, and they automatically spread them to 10 banks. So there are some kind of quirks. If you have like up to some up to millions, some even higher, they will automatically spread your money around to have a little bit more higher margin of safety. And then, of course, after 2008, one of the big takeaways was you want to have more than one custodian for your assets. And guess what? That just makes it easier to take your money out, right? And so it increases the flight in the system. But yes, you need to have some sort of incentive for people to do their homework. And one thing I want to mention, because I don't think everybody's aware of that, there is a loss in the Silicon Valley roundup, but it's not dramatic. It's about 10% that is lost. And so if you had money in Silicon Valley Bank that was above the limit, which apparently most investors had, you would have lost about 10%. So the question is that the end of the world, or is that an appropriate, quote unquote, punishment for not having done your homework? And importantly, the weekend that the collapse happened, I was at a dinner, and one of the guests was late because she was helping to arrange some emergency funding for their they're working for a venture capital company for one of their target holdings. There is a private sector role that can provide bridge financing in these situations. In addition, if you get an FDIC receivership certificate, you can go to one of the banks and get a loan against that, right? Not 100%. And so this talk about that there would be a collapse of the system is not right. Now, the other aspect of that is, well, it helps prevent the spread. Well, you have a spread if you have other weak institutions. And the way to fix that is not with a band-aid, but by fixing the underlying issue, which is a lack of capital. And so not by dragging companies like First Republic along, but by coercing them to accept more capital, which obviously will dilute the existing shareholders, quite dramatically so. But they got to take those tough steps. So there is, rather than applying a band-aid and thinking, oh yes, everything will go well, and going back to to take this in broader perspective, the Fed wants to be higher for longer because they want to fight inflation. We can talk about whether they do this the right way or not, but that's what they want to do, and they do this by higher for longer. And so just when they were earlier at a zero rate policy and were kind of trying to extinguish the various fires of unintended consequences, they do the same thing now at the higher end and say, all right, we have rates high, and yes, stuff will break, but we'll patch it up. And so the question is how long they can do that, right? And maybe, at least a few days ago, the market perception was, okay, everybody's moved on, bank earnings are good, and this band-aid kind of holds and will go higher for longer. And so if you ask me what will happen, that appears to be the attitude. Yeah, they'll just keep pushing rates a little higher and see whether everything is going to stick. And if not, then we'll deal with the consequences.
Mm-hmm. Well, we have the Fed meeting coming up in May, higher for longer. Do you expect them to raise again, or will we see a pause? What do you think, based on what you've been sharing?
As we are speaking, there is an 88% chance of a rate hike on May 3rd, and then the next one on June 14. It is there is a little more priced in, but 88% is a rate hike that's priced in. The rate cuts that were then priced in down the road are much less than they were in the immediate aftermath the crisis. So in January of next year, we have less than 2 rate cuts versus today priced in. And so the higher for longer message is sinking in. And a little context here, maybe. When the market prices in rate hikes or even keeping rates at a high level, if you go out further, the market will always price in some cuts because there's always the unknown that will hit you. And if the derivatives one can trade, I'm not encouraging that people do that, and banks, by the way, do that to manage interest rate risk. So the stuff that Silicon Valley Bank didn't do, you can hedge your risk, and the pricing of these derivatives is such that the probability of the unknown shock hitting you increases as you go out with time, and therefore the market is pricing in some rate cuts. So some of that is completely normal. The other part, of course, is will the sort of rate hikes we've seen do so much damage to the economy that the Fed will cut? And I already mentioned the Fed has taken away kind of measures of health from the market because they control things at some point across the yield curve. You don't see the risk in banks anymore. So we don't know what's really happening out there because everything is micromanaged. I mean, command economy is something that you might use as a term in the Soviet times, right? But the Federal Reserve doesn't really see what's happening because the yield curve is not a proper reflection of what's out there. A lot of these health metrics aren't. And so instead, what we got is a committee that decides on what to do. And despite having given us the Great Inflation, the Great Depression, and now another bout of great inflation, we think that the committee can decide on and do things right. Now, obviously, they control the bazooka, so we pay attention to it. But we know that monetary acts with a lag. And so let's take commercial real estate again as an example, right? We've already seen an increasing number of these selective defaults. That will create stress in the regional banks because they're not used to managing these buildings. They will sell them, putting downward pressure on the prices. And that has the risk of creating a downward momentum in those commercial real estate prices, which will put even bigger pressure on the banks. Now, what Powell has said, they can always cut rates. Well, if you have some falling dominoes and you cut rates, they will not be suspended in the air. Now, I'm not suggesting they'll crash and burn entirely. It really depends on the circumstances. But there is a lag effect of what's going to happen. And what the Federal Reserve wants to do is, okay, they want to tighten monetary policy because they think they need to, and because they haven't quite fixed inflation yet. And when some fire breaks out, they'll fix it. And we've seen how they fix it, right? By converting acute problems into chronic problems. That's what I call when you convert those treasury securities, for example, if you park them at the Fed.
Yeah. There even more to explore with you. Okay, on the inflation fight, on the Fed fighting inflation, do you think they can be successful? Do you see a scenario where you can get back to the 2% target? Or do you think that we'll have just persistently, higher, stickier inflation in the years ahead? What are your thoughts?
Well, we're all big fans of Ben Bernanke, so let me quote him. uh,
Okay.
Now, let me rephrase. Even Ben Bernanke, um, he wrote this book on how to do monetary policy, and it was all about, once you're at the zero lower bounds, be creative, everything we've done today to the starting point. And before he finished writing the book, inflation hit us. So he quickly added some chapters on that. And what he writes, and I agree with him on that, once you have high inflation, it's no longer linear. It doesn't just go up and then goes down. And so it can whack you, he doesn't use that terminology, at any time from anywhere. And the reason I say that is there is no assurance that higher for longer is going to get rid of inflation, right? Usually what happens, you hit with a supply shock, and then when you hit with a supply shock, the economically sound thing to do is politically very unattractive. So, example, energy prices are very high. Heating cost is high. You see that in Europe, right? Ukraine war, heating cost is high. Well, the governments are start sending out checks. Well, sending out checks does not increase the supply of oil and gas, right? And the economically sound thing to do is let the market prices clear. And so that's how you create a stagflationary environment where you create these inefficiencies and induce high inflation, and you don't fix the underlying economic issues, and with that you get an economic slowdown or recession. And so the question is, and people say, oh, we are so much smarter than we were in the 1970s. We are still human beings. You still have politicians that want to do, quote unquote, the politically attractive things. And so that creates unstable dynamics. And so yes, the Federal Reserve can keep rates high until inflation is a little lower, but we have no assurance that we'll have beaten inflation by the time it's time to cut. And the Fed knows that, and that's why they say higher for longer. But at the same time, the only thing it means is that they don't have a strategy what happens afterwards, right? And to just give you another idea, the alternative, instead of listening to every word that Powell is going to say when he's finally going to cut rates, what about if we had a rules-based system based on inflation and unemployment, because that's the mandate of the Fed after all? Well, then the market would focus on what inflation will be and what unemployment will be. And we could get a much more stable environment where we could get more sustainably go down to 2%. Instead, we're giving this to this committee that is noodling around. And sure, we can cause economic damage, but maybe it causes inflation, maybe it doesn't. I don't think anybody knows. And worst of all, these guys don't even recognize that they have an approach that's fundamentally flawed.
Yeah. You mentioned the word stagflation, and I want to hear your thoughts there, your thesis on stagflation. And also, like, when I think of that, like, how long do you think we could find ourselves in a stagflationary environment?
So first, for full disclosure, we launched a stagflation ETF a year ago. So I'm talking my book here maybe a little bit, but it goes the other way around, that we actually, to answer your question, we wouldn't have done that had we not thought that this is a longer, more persistent issue. The stagflation in the 1970s actually started a little bit before the 1970s and lasted into the early 1980s. And the reason is precisely because policymakers tend to mess things up along the way. And so, of course, the economy is different now than it was then, but at the very least, I like to look at the world in terms of risks. The risks we have that stagflation is a more extended process, right? And again, it's because it's not linear. And what gets my confidence low that we'll just quote unquote fix it is precisely because of I don't think we have a strategy with higher for longer.
Yeah. Let me ask you this too. And I might be wrong. Okay, so and you can correct me if I'm wrong. I think in 2008 you got out of equities. Is that right?
So no, I got out in late 2007.
Oh, 2007. Oh, well, hey, even better. Look,
Yeah.
okay,
So,
okay, got my year
so
wrong.
yeah, no, but that's correct. So in 2007, in late 2007, I sold all US equities I had. The one regret is I also sold Apple amongst them. I had bought Apple when Steve Jobs came back to Apple. At the time, it was very unpopular. And so Apple, of course, has done tremendously well since then. And then in addition to that, in September 2008, I took out substantial cash. And then I mentioned, right, we managed a little over $1 billion in gold and gold mining. We started as a family in 2004, a gold and college savings fund where we are putting aside physical gold based on the number of children we had, based on when they would be 21, so that every year how much gold would be put aside so that we would be able to afford college for the kids. So they could go with a laundry basket over to the counter. They never went there with a basket. But in 2008, we decided to use the proceeds from the equities to fully fund that college fund to kind of set the priorities as to, okay, that's something that's important to us. A nice fun fact, for several years, the cost of college tuition decreased. And the reason I say that is as far as ounces of gold are concerned, that college cost. And obviously, the last decade, there was some reversal of that. But for a few years there, or for several years, the cost of college tuition when priced in gold was declining.
Yeah. Well, the reason I bring it up, because I want to know, like, and I don't know how much you can share, and maybe you'll share a lot with us, is how you want to think about portfolio construction in these more uncertain kind of environments. Like if we're heading more for a stagflationary environment, or if you're expecting like a recession, because that's why I brought up like getting out of equities in 2007. How do you think about how you want to structure a portfolio?
Yeah. So first of all, my speech is regulated, so I cannot give specific investment advice. So take all these as kind of big picture things. Let me maybe mention a very basic principle. You should not have more in risk assets than you can sleep with at night. And with that, I don't mean the gold bar on the pillow, but if you lose your sleep over your investment portfolio, that means you are overexposed. And that might sound easier said than done. I feel very strongly that in the spring of 2009, when we reached a low in the equity markets, some people said you should load up on equities. I happen to think that for a lot of people, that was completely irresponsible. And let me explain. Even though it would have been most likely profitable. The reason why people get in trouble is because during the good times, it's not just governments, individuals don't rebalance their portfolio, don't take chips aside, which means that at the peak of the market before the financial crisis, they were overexposed and they lost more on the downturn than they could afford. At the bottom, they had done substantially less. The answer to that is not that you double down on your risk profile. The answer is, of course, that from the get-go, you have a prudent strategy that you can work with. It's like doubling down in the casino, right? Oh, I didn't make money. Well, I double it. I bet on red again with twice the money, 4 times, 8 times, 16 times, right? That is not a prudent strategy. And so the one thing I can say is that it doesn't really matter what plan investors have. To some ways, the important thing is to have a plan. And notably also when you're worried about the market, have a plan, market to take your money out, have a plan when to take it back in. And so that's one thing people tend to forget. Oh, I like this security or this investment or this fund. Well, are the reasons why you bought it still valid, right? And I don't care whether you're a day trader or long-term investor, but having a strategy, I think, is most helpful. Now, you mentioned stagflation, right? Or recession. First of all, the reason why recessions are important for investors is because historically, equity market and risk assets in general tend to do rather poorly during recessions. And so if you're able to predict recessions, you can have a strategy that might get you better off at the end of the day. Now, I say might because it's easier said than done. And who knows whether this time is different. I mentioned earlier, this is the most forecast recession ever, so that can change some parameters. Mentioned stagflation. I mentioned we have a stagflation ETF. Part of the reason why we launched that one is because we wanted to offer something that provides diversification in an environment where other things don't work so well. So in the 1970s, equities especially on an inflation-adjusted basis, did rather poorly, but bonds also didn't do too well. Like last year, also very few things did poorly. So we wanted to have something that has a bit more like of a bond-like return stream, but it's different. And ultimately, what you want to look for is for real diversification, right? I mentioned we do a lot in the gold space. Well, gold over the long run has a near zero correlation for equities. Historically, it's done well. You never quite know why you should have that brick that doesn't have a yield for tomorrow. But historically, it's been a good diversifier. Last year, it wasn't as good a diversifier as one would have thought. But when one says something has a zero correlation or low correlation, it doesn't mean it has a low correlation every day. These things phase in and out. And so again, it comes down to having a strategy of what one is comfortable with, right? And that means different things for different people. You talked to Ray Dalio the other day, and he didn't want to let himself be buttoned down because he can't give specific investment advice. But one of the things that, if I understand Bridgewater correctly, they of course have these many different strategies that they compilate, and they do a lot of that with derivatives. But one of the things big institutions, including them, are doing is there's something called the risk parity strategy. That's a strategy where you allocate quote unquote equal buckets of risk to equities and bonds. And bonds are obviously supposed to, at least not obviously, are supposed to have a lower risk profile than equities. And so they tend to be geared up on the bond portfolio or have a substantial higher bond portfolio. And then they have to rebalance when something happens. Well, it turns out this strategy, and I say that because that can apply to many other strategies as well, works well as long as inflation is low. But this permanent portfolio of allocating these equal buckets of risks breaks down because bonds don't behave and provide the sort of diversification they should if you have a high inflation environment. And so during the decades when bond yields were coming down, bonds were a great investment, but they're not always a great investment. And I'm not saying people shouldn't invest in bonds, but people need to be aware of the risks that they have when they take anything. And one of the big problems of the post-2008 environment was the Federal Reserve got interest rates low, equities were going through the roof. And so that threw out any active management because by definition, on average, the average investor is not above average. And so people just stuffed all the money into some big name index funds. And then it got a little bit more nuanced because everything went up. Well, why not invest in what I like? So let's invest in something green. Let's invest in something this. If everything goes up, I might as well. Well, now that rates are a little bit higher, the fairy tale land is coming to an end. And maybe people have to start thinking again a little bit more about asset allocation.
So I want to hear more on your thoughts on the bond market. Something we talked about at the top. I want to hear more.
Well, I mean, the bond market is a big field, right? From long duration to short duration, from good credit to bad credit, to domestic, internationally, like all these dimensions, and you can quote unquote play it in many different ways. Let's talk about the simplest thing of it, short-term treasuries, right? There is nothing wrong with holding short-term treasuries that are currently yielding quite a bit, right? On a quote unquote risk-free basis. And if they're very short term, you don't even have the duration risk that you have in there. I mentioned gold earlier because why would you hold this barbaric relic, right? That doesn't show the pay a dividend. Well, not everybody anymore, but most people have a $20 bill in your wallet. Why do you have a $20 bill in your wallet? It doesn't pay any interest. Well, it serves a purpose, right? It may not be a huge factor in your overall portfolio allocation, but there is a role for any one of these things. The further you go out on the yield curve, on duration, the more risk you're taking on, because a lot of things can happen. And in the short term, like out to 2 years, you mostly worry about what the Federal Reserve is going to do. But out there, a lot of things can happen. If you have more red tape, for example, in the economy, it reduces the potential of an economy. That can weigh on the risk. Inflation can weigh on it. So there's a lot of that stuff that's happening. Should maybe mention tips in this context, a very misunderstood concept, inflation protected securities. When you buy tips, you're buying real yield. Now, it might be a little bit too arcane for this audience here, but you're getting an adjustment for inflation as it comes down the road. Now, many people say, hey, but I don't trust the CPI, but at least you're getting the CPI adjustment. And so if the real yield is changing, and so last year, for example, as the Federal Reserve was very tough, real yields were moving higher, which means if you had a longer dated tips, they were actually losing in value because you had locked in the real yield. The real yield was moving higher, which means what you purchased earlier is now lower. So the new buyer of those bonds is making a bigger return. But conversely, what it means is if you think we are peak hawkishness, then suddenly tips might become attractive. So I can't talk about all the different variations here. The one thing I can mention is I tend to trust the bond market a bit more than the equity market. One of the things there that we've seen recently is that commercial real estate, to kind of close the loop on that, as of a few weeks ago, is trading closer to junk level. So the bond market has woken up. That something might be happening there, and that's one way for these bonds to make it to hands that accept the risk, and that makes the system more stable. And maybe let me put in one more rant here, one more comment. The role of the regulator is not to prevent you or me or your listener from making a bad investment choice. The role of the regulator is that your or my or anybody else's stupid investment choice doesn't wreck the financial system. And so that's how the system can work better. We don't need to protect everybody from doing stupid stuff. We need to protect people from my stupid stuff wrecking the rest of the folks out there.
Good point too. Maybe also like learning from the stupid stuff that we do as
that
well.
That would be very helpful. Yes,
yeah.
If people learn from other people.
Yes. Learning from mistakes and failures, it does work.
Yeah.
Let me ask you this, because there's been another reason why I'm excited to have you on, because I do know you have a lot of experience in currencies as well. There's been a lot of talk lately about this narrative around de-dollarization. What is your take on it, and what is your outlook for the US dollar?
So let me answer that in several different ways. There is, first of all, a lot of people, and I may have mentioned this last time we spoke, but in a crisis, the dollar often goes higher, and people talk about the flight to quality. What it really is a short squeeze. When an economy is expanding, people borrow in US dollars and to finance projects. And a lot of emerging markets borrow in US dollars. When you borrow in US dollars and to finance something in another country, it's a short sale on the dollar. And it also means when there's a crisis, we de-lever. That means we reduce that sort of thing, and that provides an upward pressure on the dollar. So just for context, that when we have this quote unquote flight to quality, think about it as a short squeeze. Then the second dimension is, historically, when you have recessions, it often provides kind of secular changes to how the dollar is moving. And we have argued, and I continue to argue, that with the kind of the post-COVID pandemic, last fall, we had a secular change that as the Fed has pivoted, and I claim the Fed has already pivoted from the 75 basis point rate hikes, 50 basis point rate hikes to now 25 basis points, that kind of puts us into a new phase where the dollar is gradually weakening over the next several years, with ups and downs, obviously, and we've seen that we have not reached the peaks of last fall. So that's for context. And in addition to that, of course, the theme that you're bringing up there's for many, many years, there's been this talk about the de-dollarizations, and the folks who don't believe in it have kind of shrugged it off and saying, well, the dollar is still king. That's the only game out there. That's all true, except what has happened in recent years and amplified with the war in Ukraine is the dollar has gotten weaponized. Um, if you have assets as a Russian, especially a Russian of influence, your money is not safe anymore. Every, most countries, not all countries, but most countries, including Switzerland, have signed on to that, which means if you're a bad boy out there, you have an incentive not to be in that system. Indeed, it's not just the dollar system, but you also don't want to be in the SWIFT system, the international payment network system. And it's part of the reason why several central banks around the world have increased the gold holdings, because that's one way you can potentially be out of that. But more so, it does intensify the efforts of some of these countries to create their own network. Just as it used to be, I'm not sure how many of your listeners are aware of that, we are all used to the GPS we have in our car. Well, it used to be that the US system was the only one in the world. At some point, the Chinese figured out, well, the US can just switch that off for the Chinese. So they can't have the military equipment be based on that GPS system. So they developed their own parallel system so that they're not dependent on that global positioning system that the US makes available to the rest of the world. And of course, it's not easy, but the efforts in that have increased. And we know about the efforts of the digital currency that the Chinese are developing or have developed. Those are all, I'm not suggesting that will necessarily take over the world or be the true competitor, but the risk of people moving out away from the dollar is more than theoretical these days. So we have taken it up a few notches, and it's not like tomorrow there's going to be a good alternative that's out there, but these are very serious concerns if you're Russian or Chinese, and they will work on finding a solution, and at some point they will. And so it's now the counter position to that is there's a reason why the US markets are, comparatively speaking, the deepest, most liquid in the world. But you can't rest on that. And obviously, if you do other quote unquote stuff that's not helpful, like if you were to guarantee 20 trillion in bank deposits, those are things that are counterproductive, because even a country as mighty as the US is, that's something that's a serious problem in that context.
Yeah. You mentioned too, like central banks buying gold, I suppose, is a way to diversify from the US dollar. And I know you, as someone who also has a lot of expertise in gold, what are kind of like your latest thoughts on, gold today and where you see it headed?
Well, I try not to give price targets, but I can give you a few things. So what we see is different types of gold investors. There is the investor who's concerned about the purchasing power of the dollar. That interest has significantly picked up in recent weeks. There is the investor who is interested in gold for diversification purposes. So that's last year, the diversification didn't work as well. That works better again. And so that comes and goes a little bit in waves. And the third type of investor is the speculator. It's like your meme stock investor. And once the digital currencies came around and meme stocks came around, volatility in gold, in at least my view, actually came down because those speculators went elsewhere. That said, if you have a good rally or a good decline, they will jump back into the game. And so that's kind of the context that to help see what sort of dynamics there are. The other one, as far as valuation is concerned, one key parameter I look is real interest rates, longer term real interest rates. Now, I mentioned already earlier, a lot of people don't trust inflation numbers and whatnot. And then if I look at, well, what are long-term inflation rates or long-term real interest rates? Now, nobody knows what inflation is going to be in 5 or 10 years from now. But what these longer term inflation measures are, they are measures of confidence in the Fed. And so, and relative changes matter there. And that is why the correlation of the price of gold to longer term real yields is reasonably high. Again, like anything else, those correlations phase in and out a little bit, but it's one of the key things that we monitor. And if you think about it, given how high real rates were pushed, gold has done quite well. Now, and then if part of that is gold historically has done well when recessions are deeper. If you have a shallow recession, equity prices discount what happens, move on, and gold doesn't do much. But when you have a more severe recession, equities tend to not do so well because earnings get really hammered. People are insecure. The market is pricing in lower rates, which is a good thing for the price of gold. And so that's why if you have a more severe recession, the price of gold tends to do better. And then, of course, that then spills over to gold miners that on the equity side tend to do better. The junior miners in particular have a lot of credit risk, so be careful with those. But if I look at the market action, the bond market and the gold market is telling me that the recession is more severe. If I believe my own macro talk, and I am biased, I do believe it, then I also think the recession is going to be more severe. If I look at the equity market, that's still trying to get used to that sort of notion. And so, and of course you don't know, right? Equities could always rally, but from my risk assessment, the equity market is a more precarious place than some investors are appreciating right now.
Yeah. I'm going to try to squeeze in two more questions. I want to get your take on the debt ceiling, the fight that's looming there. What are you thinking about as it relates to that, especially as an investor, like from an investor's perspective?
Well, it's part of the system, right? I don't think anybody likes it, but we hear always, right? We've made this commitment, we need to pay them, but we also know that government loves to write checks as entitlements have grown over time, and so if for better or worse, probably for worse, the debt ceiling has become one of these junctures where historically those issues are debated more so than others. And so that's part of the system we're in, and it just comes with the political system. And it's not whether we like it or not, it just is. That doesn't change the fact that it's dangerous. We talked about de-dollarization. You can lose a lot of trust when people don't pay the debt. You have to price that in going forward if that were to happen. Now, some people say, "Oh, it's just a little thing. You price in that you get your money a little bit later." Well, in 2008, all hell broke loose, and it got people's attention, and suddenly they found a compromise. And so I very much hope it doesn't come to that. But I've also mentioned in the past, not on your program, that hope is not a strategy. And so if you look at how treasuries are priced, when the market thinks the money is exhausted for the debt ceiling, you see little kinks in treasuries. The big problem is really the reaction to it, right? The Federal Reserve, first of all, if there's a default on treasuries, by law and regulation, they are safe. But if they're in default, what sort of collateral, what sort of liquidity can you give against that collateral? So it creates a political hornet's nest for the Fed, because if you reach the debt ceiling, it's the will of the people that we default. So what is it for the Fed to say that they keep things greased, that they keep liquidity, right? It creates like an impossible situation for some of these decisions. Do you go against the law? Do you go against the spirit of the law? And so aside from the fact that we'll probably have a blow up in liquidity, it's going to draw the Federal Reserve into more politics. And then let me just take a step back here. I don't think we've talked about that, why that's a bad thing. You may love or hate the Fed, and I have my views that things should be run differently, but a central bank is run more efficiently when it's independent. When there's political interference with the central banks, they're less effective. Because if they get torpedoed by somebody credible, then rather than saying a few words to move the markets, they have to move interest rates, engage in QE, do other things. And so it's in the Federal Reserve's interest not to step on the political turf. Unfortunately, they forgot about that, and ever since 2008, they have stepped onto political turf. I'm a bit of a purist in that. I do not think it is appropriate for the Federal Reserve to hold mortgage-backed securities. And mortgage-backed securities allocate money to a specific sector of the economy. That is not monetary policy. That is fiscal policy. So the Federal Reserve should have nothing to do with that. And of course, we've had so many emergency measures that are each one of them kind of going down further the road of fiscal policy. And they're unelected people, right? They're unelected officials. And I get it, right? I mean, ever since its founding, the Fed has been a popular punching bag by politicians on the left and the right, and that's never going to change. But they don't need to attract more of that through their behavior. And so back to the debt ceiling, it can undermine confidence in so much more than just, oh my God, maybe something is going to happen in the short term, right? You're unleashing unstable dynamics in a highly levered system that can be extremely detrimental. And so that's kind of the part of the reason why it is not a good idea to go down that road.
And I think that's such an important part. And it kind of ties back to what you were saying at the beginning. And, you know, a lot of folks, I'm a millennial, and then there's younger generation, Gen Z. They think that what we've had is capitalism. But as you point out at the top, it's not true capitalism. So my final question for you is, how do you diagnose that? And do you think there will be a time where we actually get back to, you know, more pure form of capitalism?
Oh, goodness. Well, first of all, if you want to torture yourself, read that book by Bernanke that I pointed out earlier. I used the word command economy earlier, and it was, I had put that in there because if you read Bernanke's book, he really would like to do anything to get unemployment down. And that's really what you had in the Soviet Union, right? There was very low unemployment. But that's not the sort of system that I think we would want to have. Now, there is a pendulum, of course, that swings, but I think each one of us has a responsibility to promote the merits of capitalism and what capitalism is, because we can't take it for granted. If somebody has an extra 50 hours or so, read or listen, I listened to it, Adam Smith books of the Wealth of Nations, kind of the founder of the laissez-faire economics and so forth. And he was skeptical on a bunch of things. I mean, capitalism isn't perfect, but what we have is not capitalism, right? Just take 2008, right? The mess we had in 2008. Many people, the lessons they took away, that was a political piece of work that tried to stuff all the blame on certain aspects of the economy and certain players, notably the bankers. And I'm not saying the bankers haven't had their role in it, but people react to incentives and to mandate. And so many people may not be aware that, I think it was in 2004, 2005, unelected officials, bureaucrats, forced the GSEs to lower their underwriting standards. And then the GSEs didn't publish financial statements. So again, it was as they were required to do. And people blame the Fed for having missed the boat. And yes, they missed the boat. But the little excuse they have is they weren't given the data because they were hiding, they were hidden from them. It's again one of these things, right? And by the way, the trouble of the financial crisis, in my view, was placed when the GSEs were founded in 1930. It took 80 years to blow up. And some people say, well, then you can't blame them. Yes, I do blame them. And why is it that the government needs to guarantee mortgages? And that's not capitalism. There's plenty of liquidity out there. And so we should all work to get rid of some of these things. Now, will that happen? Well, I think, again, with a pendulum swinging back and forth, it's if you want to have depressing reading, there is much more readable than Adam Smith's work. There's a book, The High Cost of Good Inflation, that goes through the entitlements since the founding. And it's a very depressing reading because every several decades, the pendulum swings the other way. but then that's undermined and we move again towards more entitlements. And I don't have a problem with entitlements per se, but you need to be able to finance them. And we can't. They're unsustainable, right? That's the real problem. So we can fix some of these things. That said, there I'm on board with Ray Dalio when he talks about his different cycles. I'm not that much of a student of it. Are we in the fifth or the sixth of the periods? But in any case, what he talks about is that these nations, they grow, they expand their spending, and then they at some point disintegrate, and that disintegration is often not peaceful because you have other powers that rise. And so if we don't take this stuff seriously, maybe within my lifetime, quite likely, or with the lifetime of my children, geopolitically stuff will happen that is not good, right? The tensions we have, I think what's happening in Ukraine is just a symptom of the new world that we live in. And part of it is the US is overextended, can't be the policeman of the world anymore everywhere. And so you have these cracks show up. The reason why we've had such prosperity since World War II is kind of a side effect of the Pax Americana, but that was the intent of that was never to foster global commerce. It was because there were the bad Soviets and they tried to secure that, and the side effect was a great global economic growth. And so we need to kind of defend the values of capitalism, but be keenly aware that the road we're on is not a stable one. So I'm not fooling myself and thinking that what's ahead is not going to be Ayn Rand type of nirvana capitalism. I don't think that's the direction we're heading in.
Yeah. I have to say, Axel, it is always illuminating having you on. I love listening to you and learning from you, and it's a sobering picture too that you paint there, and it's important to heed the message. Do you want to let folks know where they can find you, follow you on social media, read any of your work, or learn more about you?
Do they want to find me or hide under the mattress after listening to me? Well, you can come to merkinvestments.com and sign up for our newsletter. That way we can keep you informed. If you want my real-time unfiltered news, follow me on Twitter at Axel Merk. Those are probably the best two starting points if you want to engage me. And as I indicated, right, I love talking. I love talking to you. And if that provides food for thought for people, I think then it's an hour well spent. Yeah.
Likewise. I love talking to you as well. Axel Merk, founder and CIO of Merk Investments. Thank you so much for being so generous with your time and ideas, and would love to have you back on in the future. Thanks again, Axel.
My pleasure.
Hey everyone, I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.